Hello, in this video, we'll be going through prior service costs. Let's briefly discuss the different types of pension plans. There's primarily two different types. There's a defined contribution pension plan, which we're all pretty familiar with because they're the typical 401k plan, is an example of a defined contribution pension plan where the employer contributes a certain percentage of the employee's salary, and then the employee decides how to invest that money. And then at the end, when they retire, there is no guarantee as to how much will be in their 401k and therefore how much they will receive upon retirement. There's also defined benefit pension plans where there's a promise to receive a fixed benefit, meaning a fixed amount upon retirement, and that's determined based on a pension formula. And there's a lot of different factors that go into that pension formula. When a company has a defined benefit plan, they have what's called a projected benefit obligation. And using all the, they have to estimate their retirement benefit that they will have to pay upon an employee's retirement. And that measurement, it's a liability, right? Because they have an obligation to pay their employees when they retire. That's going to be a pension liability on the balance sheet. And there's a lot of nuances that go into the calculation of the projected benefit obligation, that liability. If you want to see more detail, you can go see the video called Projected Benefit Obligation. I'm going to quickly go through the same example we went through in that prior video because we're going to make some alterations to it later on. Callie Fowler was hired by Global Communications at the beginning of 2016. The company has a defined benefit pension plan that specifies an annual retirement benefits equal to 1.5% times the years of service times the final year's salary. And Farrow is expected to retire in 2055 after 40 years of service. The retirement period is expected to be 20 years. And at the end of 2025, 10 years after being hired, Farrow's salary is $100,000 and the interest rate is 6%, and they project that their Farrow's salary to be upon retirement will be $400,000. Let's quickly go through how we calculate the projected benefit obligation at the end of 2025. So first, before we get into the calculation, it's always important to put a timeline. It says that this employee got hired in 2016, and then we're looking at 2025 here after they've been working for 10 years, and we're told that they're projected to, what is it right here, Farrow is expected to retire in 2055 after 40 years of service. So we know that the remaining service period that they have left is going to be 30 years. And then once they retire in 2055, which is right here, we estimate that they will have 20 years of retirement. So let's go into calculating the projected benefit obligation, that liability. And our formula is the 1.5% that's determined by the company multiplied by the years of service that she's already worked, multiplied by her final salary, which is $60,000 per year. So she estimates, or in this problem, we estimate to give this employee $60,000 per year for 20 years upon retirement. Step 2 is we have to take that $60,000 annuity payment and present value it back to, so we have that 60,000, I'm sorry, each year, right? We have to present value it back to 2055, the retirement date. And this is the present value of an ordinary annuity. And the factor is 11.46992. So we take the annuity payment, which is the annual payment, 60,000, multiplied by that factor, and we get $688,195. And then the step 3 is we're going to have to take that $688,195 right here, and we present value it to the date of what we're trying to calculate, a projected benefit obligation, which is at the end of 2025. And then, so we're going to take that 688,195 multiplied by the present value of a dollar factor, which is 0.17411, and we get a projected benefit obligation of $119,822 at the end of 2025. Again, if this was going too fast for you, or you don't know what didn't really follow through or follow this example, I go through in a lot more detail in the projected benefit obligation video. Let's get into what is a prior service cost. It occurs when a pension plan is amended, which can happen, it's not infrequent or not rare. Credit is often given for employee service rendered in prior years, and the cost of doing so is prior service cost. So in our original example, the pension formula was 1.5%. If I'm going to look right here, this is how much they determine the employee to get upon retirement, and one of those factors is the 1.5%. Okay. Now let's say that the company has amended in 2026. They changed the formula salary percentage from 1.5% to 1.7%. So the payout in the future will be greater. Well, for the employees that have worked up to the point of 2026, right, that have years of service under their belts already, what the company does is they say for those years of service that you worked, which in our example, this employee worked 10 years, we're gonna increase that 1.5% to 1.7, and we're gonna essentially give you credit for that, right? So it's gonna be as if you were earning, the formula was 1.7% from the date of employment. So the way they do that is they have to record a prior service cost. Before they record that, they have to figure out what is this new obligation. So what happens is that they go through the same formula, except now let's calculate a projected benefit obligation at the end of 2026 or the beginning of at the end of 2025 or the beginning of 2026, same difference, using 1.7. So again, our payout is 1.7% times 10 years times 400,000. So in this situation now, the payment has increased to $68,000 per year, right? So now we have $68,000 in payment upon retirement each year. We have to take that $68,000. Step 2 is present value of ordinary annuity. So that amount would be $779,955. And then step 3 is we have to take that full amount and use the present value of a dollar table and present that value that back to the end of 2025. And our new obligation our new projected benefit obligation is $135,798. So we have to calculate our PBO at 1.7, and then we're going to compare it to what it was at 1.5. So here, without the amendment, it was at 1.5%. With the amendment, it's 1.7%. And the difference between our projected benefit obligation is, right, a projected benefit obligation, sorry, at 1.5% is $119,822. Our projected benefit obligation with 1.7% is $135,798. So the difference is $15,976, and that is our prior service cost. Our obligation has now increased by this amount due to this amendment, going from 1.5% to 1.7%. So let's see how this factors into our accounting. Previously, right, we had our PBO at the beginning of 2026 was $119,822, and then they amended the plan for the payout to be equal at 1.7%. So we have to increase our PBO by the $15,976. So now our new PBO at the beginning of 2026 is $135,798. Okay, so this was our beginning PBO. Now this is our new amended PBO at beginning 1/1/26. We adjust the beginning balance of that liability account. So let's calculate what the service cost and interest cost is for 2026, right? Because this is 1/1/26 right here, the 135,798. So the service cost is made up of, we have to first, we're going to take 1.7%, right? Multiplied by 1 year. That's because we're only doing this service cost for the 1 year. So each year we have to calculate a service cost. We multiply by 10 years in the prior example, well, in 2025, because we were just showing what the service cost would be for the full 10 years. But now we're only doing it for the 1 year of we're doing 2026 here. Multiplied by, we have to discount whatever this amount is. We have to discount the present value of an ordinary annuity. Our N equals 20 because it is going to be 20 years of retirement, and our interest rate is 6%, we're told. And then finally, we'll multiply that number by, we have to present value that by $1. See, present value of $1 at 6%. But now, because we are now doing this for the end, we're trying to calculate the projected benefit obligation for the end of 2026. Our time period is now 1 year closer to 2055, so our N equals 29. Whereas when we're doing the PBO for 2025, our N equaled 30. Okay, so that's step one of figure out our projected benefit obligation. That's the service cost for the year. That's going to increase your projected benefit obligation. So it's a credit to the PBO, and your debit would be to pension expense. And then also you always have to factor in the interest cost, okay, because this is a long-term liability. And the way you do it is you take your projected benefit obligation at the beginning of the year, multiplied by the interest rate. Notice that this beginning of the year PBO right here is after the prior service cost amendment. Okay, it's after the amendment, after we have factored in, after we have increased our projected benefit obligation for that prior service cost. It is not the $119,000. It is, you're going to calculate your interest cost based on the newly revised, essentially, beginning PBO number of $135,798. And that will give us our ending projected benefit obligation at the end of 2026 for $150,341. Okay, now let's go over some journal entries. So what happens with that $15,976? We know that we have to, it increases our projected benefit obligation, which is a liability. So we know that we are going to have when we book our debit, our journal entry, our debit, and our credit, we have to increase our projected benefit obligation by the $15,976, right? So we're going to have a credit to that account. What is going to be our debit? You could, well, we're not going to, but upon initial thought, someone might say, well, it should be pension expense. But the FASB has ruled that rather than taking that expense in 1 year, we're going to amortize that this cost, this prior service cost, over the average remaining service life of the active employee group. Okay, so I'll go through that in a second, but the second bullet point says the prior service cost is reported as a component of accumulated other comprehensive income, also called AOCI. AOCI. So if you recall, OCI's other comprehensive income goes on this balance sheet. It doesn't go in your income statement, but OCI closes out into accumulated OCI every year, just like our net income closes out into our retained earnings every year. The OCI closes out into the accumulated OCI. So this is the accumulated OCI is the retained earnings of OCI, if you want to think about it that way. But what we're going to do, right, on 1/1/26, when we amended this pension plan for the payout to be 1.7, we're going to debit, we would debit OCI, and then the end of the year, we're going to close it out to AOCI, to accumulated OCI. So I'm just going to put it to accumulated OCI, just so we don't have to do multiple journal entries. But essentially, this is what will happen eventually. And we're going to have a debit to the accumulated OCI for 15,976 and credit to the projected benefit obligation. Let's just do our AOCI T account right here, and we have a debit of 15,976. Okay, let's go to see what happens with that AOCI. What happens is you take that 15,976, right? This is now we're calculating the prior service cost for AOCI, and you're going to divide it by the average remaining service life of the active employee group. So let's see what that is for this example. We were told that as of 2025, this employee had worked 10 years and that they had 40 years of service that they expected, because this employee will retire in 2055. So therefore, if their total is 40, right, and we're right here, right, the beginning of 2026, end of 2027, and they've already done 10, then they have a remaining 30 years of service left before they retire. So we're going to take the 15,976, the total prior service cost, divided by that 30 years, which gives us $533 per year for the next 30 years that we're going to amortize. And so then our prior service cost at the end of 2027 will be $15,443. Let's see how we calculate what we do with this $533. In the prior slide, we saw how we record this 15,976, right? We debit accumulate OCI and credit a projected benefit obligation. Now this that prior service cost is going to be amortized over 30 years. And the way we do that is we're going to debit pension expense and credit accumulated OCI for the 533. So keep that in mind, credit AOCI for 533. If I go back to the slide, now in 2027, I'm going to have a credit, right, in 2027 for $533. And I'm going to have that every single year for the next 30 years, until at the end of the 30 years, my accumulated OCI for the prior service cost will be 0. Let's go through a worksheet. If you're not familiar with how the worksheets, what they are, then there's a whole other video just for worksheets. But essentially for this worksheet, just to highlight the journal entry for the prior service cost, we have our pension expense column, cash, other comprehensive income for prior service cost. And the reason why we identify that is because there can be OCI adjustments related to pensions for things other than prior service cost. And then we have our memo record, which is where we record or keep track of our plan assets versus our projected benefit obligation. And those two amounts net to our pension assets / liability. So if you take our beginning here, our example is at December 31, 2024, our PBO is $277,000 credit, and our plan assets is $220,000 debit. The net of that is the $57,000 net credit. Okay, so in this example, okay, so this is a different example than the one we just worked. Okay, this is just completely different. Let's just say we have a prior service cost for $160,000. So the entry would have been debit OCI, which closes out into accumulated OCI, and credit our projected benefit plan. So our new revised balance on January 1, 2025 would be a credit to the projected benefit obligation of $437,000, right? Because we increased the beginning 277 by the 160,000. In this example, we're going to have service costs of 19,000. So we debit pension expense 19,000, credit projected benefit obligation. We have interest cost, which this interest cost, okay, I think we're using a 10%, yeah, 10%, okay, let's just say it's 10% in this example, is going to be the beginning projected benefit obligation times 10%, and notice that's the updated beginning benefit obligation after we factor in the prior service cost increase. So we're going to have a debit pension expense 43.7, credit projected benefit obligation 43.7. We have this actual return on the plan assets, which if you don't know how or what that is, we covered that in the video called under the 5 components of pension expense. And one of those components is actual return on plan assets. So our plan assets increase by 22,000. So we debit plan asset and credit pension expense. And now we have, so this is going from 1/1/25 to 12/31/2025. We have the amortization of our prior service cost. So you'll see we have, now I'm not calculating how we got the 54,400, just accept it as is for this particular example. We're going to debit pension expense for that amount, and then we credit that same column, that OCI related to prior service cost. And then we had a contribution where we as the employer contributed money into the pension plan. So our pension plan increased, so we debit 40,000 and we credit cash, because that's how, when we contribute money, that's our journal entry. And then we paid out some benefits to retired employees. And the way we do that is our plan assets decrease because we paid them out by 16,400, and we debit our projected benefit obligation, okay? We reduce our projected benefit obligation, and then remember this pension plan is its own legal entity, and so that 16,400 will actually be paid out. The cash payments will go out of that legal entity, not our corporate legal entity, okay? So that's just kind of different than what you might expect. And so let's just look, now we're going to add up each column. You look at your pension expense column and you have debit, debit, credit, debit. So we have a net debit to pension expense for $95,100, credit cash 40,000, accumulated, or I should say other comprehensive income, which will flow into accumulated OCI. We had a debit of 160 and a credit of 54,400. So we have a net debit of 105,600. And then when you take your PBO and plan assets and you add up all your debits and credits for those two columns, you get a net credit, essentially what you'll need for the year, of $160,700. So when I look at my journal entry, I have a debit to OCI for the prior service cost or accumulated OCI of $105,600. Debit pension expense 95,100, credit cash 40, and it will net out to be credit to the pension asset / liability for $160,700.